been an interesting start to the week here. We're just under 48 hours into forex trading for the week. And we have a little bit of treasury yields giveth, treasury yields taketh away. A lot of back and forth already. We'll take a look at not only the overnight rate and what the Fed is set to do in December, their last meeting of the year, but I also want to look comparatively at, I think we have 10-year yields across the world to try to decipher what has been going on with relative interest rates, not just on that overnight basis, because everybody watches the European Central Bank and the Bank of Japan and the Bank of England and the Fed. And it's like, oh, they all seem to be kind of cutting by, 25 BIP increments, except for the Bank of Japan, who hiked like 30 basis points and now has stopped. Ever interesting over there in Japan. But I wanted to, on a day-to-day basis, you see a lot of these shifts just from what treasury yields are doing and the equivalents in these different countries. So let's take a look at that in just a second. But yeah, the give and taketh away is in the US dollar weakness we saw yesterday to start the week, and it looked like a number of these markets, Euro, Aussie, might fight back.
Just a little life.
And
we're back.
Not so much. I mean, let's pull up this Euro here to take a look. You saw this rally to start the week, got all the way up to 106, which in the grand scheme of things is a very cheap price historically. It's been cheaper, and we'll take a look at that in a second. But yeah, now giving almost all of that away, and early this morning as Europe started, Glenn, got all the way down close to 105 once again. It's interesting. I don't know, man. It looks pretty rough here for this Euro. As you can see, violent move going into the election, post-election, another violent move lower for many of the global currencies, higher for US dollar. And you can see here, this is Sunday and Monday, the only green bars you can see for the last week or so of trading, and quickly sold into. Now they're bouncing back a little bit going into the U.S. session, but as you can see here, historically, the 105 to 106 range is rarefied air to the downside for this euro dollar. Yeah,
especially, I mean, has been just so interesting. You thought, a little stutter around the 107, not as much around 106. Big bounce, not letting it get to 105. But yeah, just really hovering there. Yesterday, across the board, thought, okay, dollar's been strong enough. Maybe we just kind of tick back across all these currencies. Euro got, I think, one of the biggest bounces. But yeah, right back to square one here, still under 106. And yeah, really, it's been crazy in my experience, my year and a half. This feels like just the most dollar-dominated story. We don't have much data coming out, but we do just have yields still historically high, higher than I would have guessed, given, everything we were looking at going into the election. Post-election, we're still seeing these extremes off that election hovering there. But what do you think, looking at the calendar, we don't have a lot of U.S. data coming up. What's going to take this dollar down? Like how we've seen it's just been dollar stories. We have some global data points, but those really haven't seemed to matter in recent weeks, at least.
Yeah, it doesn't seem like any of the data is really going to matter, and you saw that a little bit last week. Of course, it's important to the entire story, but it hasn't been the primary mover. I mean, we saw last week, what did we have? CPI, I can't even remember. Did we have like GDP or something? And you saw some wiggle around those numbers, but you saw the bigger moves coming in when you even had mid-tier Fed members speaking. And so it's really these markets trying to gain any more knowns around this second Trump presidency and what the Fed is going to do relative to this presidency. Obviously, there is a little bit of separation there of who's in charge of what, but everybody's just trying to glean, what is this going to look like when Trump is actually in the White House? And again, I mean, we're getting into year end, and we've had so many interesting moves the last 2 year ends, especially the last one. You'll remember that going into the end of the year, from October to December, we priced in a ton of rate cuts in the U.S., and the U.S. dollar got spanked. And then they took almost all of that out of the market in the first 3 months of this year. This year, a little bit of a different story as they're pricing out some of these rate cuts going into the year, just pricing in a little bit stronger interest rates, both overnight and out into the 10 and 30-year duration here in the U.S., and it's translating to U.S. dollar strength. And you also, to boot, have a president who is likely to be a little bit more conservative on trade and everything else, and that's affecting a lot of these major currencies. But yeah, in terms of data, I don't really see much. We can take a look at the next 7 days, and you've got UK inflation. And now these global numbers have actually been, I think, more interesting, but in a complete one-off basis.
Right.
Like you'll wake up tomorrow and you'll maybe see the pound up or down 50 pips and everything else relatively unchanged, or maybe the pound up or down 50 pips more than most of the other major currencies are moving. And that might be this inflation rate, which looks like it's supposed to be contentious. The last one was 1.7. They're expecting 2.2. And remember that UK data the last week has come in a little weak, and that pound has started to weaken a little bit. But yeah, man, nothing huge here. Same thing for Japanese inflation. You might get a one-off move there. UK retail sales, again, piling on. That pound has gone from being one of the strongest to one of the weakest, but not a lot of data. And I don't think you need it because, again, going back to this Eurodollar chart, Glenn, you're going to get plenty of organic moves in here because we're right at that inflection point of, are we going to bounce back to what's been normal, where we've traded overwhelmingly? If you looked at the data points for the last not only few years, but the last 10, 20 years, most of the data points are north of 105. But the last couple of years, you've had plenty of data points that are south of 105. But as you can see here, this is a real inflection point historically. It's almost, it looks kind of like, of course, this market has nothing to do with an inverted yield curve in the U.S., but it looks like inversion in the yield curve. Whenever we look at that data, it's always like you've got one or two, instances going back to the financial crisis and going back to the dot-com bubble where we were inverted for a handful of weeks or months maybe, but primarily in normal yield curve environment. And similar here with like Eurodollar around 105 to parity range. It'll be really interesting to see where we go.
And yeah, similar to your inversion story, that last time we saw parity and a little lower, those are quick moves.
Yeah.
And not a lot of time spent. Even I'm surprised there's nothing really even, no sustained moves around between 105 and parity really at all. We're just trading through it or back to above 105 and all the way back to 2002 when we last saw that.
Yeah, you can see here it was almost a 6-month stretch that we broke through that 105, got down under parity for about a month, and then ripped back above it and actually got back to 110 within a couple of months of that. And remember, this was another one of those year-end moves where we saw some extremes, and then from October to really the end of the year, it was a one-way move. And we're, again, kind of seeing that right now, but in the opposite direction It'll be interesting to see if we continue in that direction, if we do test 105 or 104 or even lower. Or Pete and I always talk about this, whenever you have a phenomenon that is reoccurring, whether it is something like yield curve inversion or a certain price in a certain market or whatever, gold was kind of one of these where it was like every time it got up to 2100, it would spend kind of less time there until it finally moved through it. But it's almost this like rule of diminishing returns, whereby it seems, this is completely anecdotal, that every time we get to one of those big inflection points, it maybe tests it either less for a less amount of time or doesn't move to as great an extreme. And we've seen that if I wind this chart back out, because it hasn't been, we got down to parity in Eurodollar in 2022, and it's been smooth sailing since then. We got back to 125 and whatever. You see plenty of these, back down to 106, bounce back down to 106, bounce back, and plenty of challenges down here. And we're now pretty much at one of the most serious ones since we went to parity. That's why we're talking about it. But yeah, we've seen this kind of diminishing return thing. Maybe it goes the way of gold, where we break parity and we see sustained action below that more than just a couple of weeks or months. But yeah, man, this is a pretty serious move and not very serious bounces in euro off of it.
I agree.
Let's go to some interest rate action. Glenn, you wanted to talk about this yesterday, especially because yesterday the percentages were very different. Here we have from the CME group, the Fed Watch tool, which uses Fed funds futures to price in the expectation for what the Fed, the U.S. central bank, will do at their different meetings. You can see these different tabs aligned to different futures products and the date of different meetings for the Fed. Now, Glenn, the distribution for the December meeting, which is the last one of the year and everybody's watching, the last meeting, they cut 25 basis points. At certain points, they've priced in a chance of 50 basis points cut here in December. It's been closer to 60-40, 60% chance of a 25 basis point cut, and now, close to a 40% chance of no cut at all. Yesterday, you were looking at this, and the odds were getting close to 50-50, which is higher interest rates, a bigger chance of no cut. Some pretty crazy action in here. I
agree, yeah. If you look to the bottom right, and you're looking at that 1 month ago, pre-election, 75-20, and then a small chance of, what is that, higher interest rates. But yeah, definitely the expectation coming into this fall and the year end has been definitely rate cutting and consistent rate cutting. And now we're just seeing kind of, why? Why would we? Maybe a growing chance of no rate cut here. And we've seen that play directly throughout the yield curve and into the US dollar. So yeah, yesterday looking like it would come to 50-50, but now yields down this morning and looking back towards that 60-40.
But still definitely not. By the time this meeting comes around, this distribution, if it's anything like past meetings, 95% of the meetings over the last couple of years have been, heavily in favor of one action and little to no chance of any other action, just because the Fed's been so transparent.
Except two meetings ago.
Which was close to 50-50.
Exactly, but that we all knew there would be a cut. We didn't know whether we'd get a jumbo cut or not. So slightly different. I feel like I agree. If there's no action versus action, they have been historically a lot clearer about that. The 50 versus 25, it had an effect. A cut's cut.
And it may seem like, all right, you guys are arguing over a 25 basis point cut or no cut or a 50 basis point cut. It's all cuts. And most central banks, with the exclusion of Japan, have been cutting, are looking at more cuts. And so what is the point to get so granular on this? Well, it's no coincidence whatsoever that you see the odds kind of fluctuating back and forth between the chance of no cuts and higher interest rates in the U.S. and so much U.S. dollar strength. Because if the Bank of England just came out and cut, and if the Australian Central Bank and the Swiss bank has already been cutting pretty heavily, and the ECB, if they're all cutting, and the U.S., their economy is still so strong that it's like we maybe don't need to cut, that U.S. dollar tends to see greater demand in that higher interest rate environment. And really quick, I do want to show some of the action that we've seen over the course of the last couple of weeks. Because again, you can look at those overnight rates and what the central banks are doing. They meet once every month or two. But also you can look to, 2-year interest rates, 10-year interest rates, which I believe is what we have up here, and see a little bit of, what is the reason for some of this dollar strength on a day-to-day basis. And you can rank here in the trading economics tool, which is great, by the yield itself. And you're going to see Turkey, Russia, Brazil, which you kind of don't worry about because they've got specific stuff going on in there. But if you focus on some of the larger economies, again, Australia and New Zealand, they've seen a ton of downside recently. But Pete and I have been talking about this, have held in relatively stronger than the euro. Same with that pound, has held in relatively stronger against U.S. dollar than the euro. They actually have higher 10-year yields, but not by much than the U.S. does right now. You start to look at some of these European countries, Glenn, like your France and your Germany, and you're like, whoa, their longer duration interest rates, and then down here at Switzerland, are way lower than in the U.S., explains some of that U.S. dollar strength, particularly against those currencies. And you can also take a look by, the last, week or months worth of action, and you can see that this U.S. dollar has built in more ground just recently against Germany, against Canada, and of course that Canadian dollar is at extreme lows as well. And that explains a little bit of it without necessarily having to wait for a central bank. So a couple of cool tools to explain. Again, if interest rates are diverging and one is getting higher interest rates than the other, it can often translate to forex demand in that stronger interest rate economy.
Yeah, and last point here you touched on, is 25 basis points marginal or not? But then you look at this, and the one that sticks out to me is that United Kingdom, that the British pound, U.S. dollar, we're right there on the same cutting cycle. And so these real 10-year yields, very close as well. And so a lot of that relative strength you can directly map, whether it be day-to-day or on these central banks.
No, exactly right. Because, if the UK cuts the next 2 or 3 meetings and the U.S. doesn't, that's a huge difference, and that'll translate to that pound and dollar. But that'll do it for today's episode of Forex Focus. Glenn, thanks for jumping on. Some great insight into both dental work and interest rates and Forex. Thanks everybody for watching.
Pete who?
Yeah, that's right. Don't even remember that guy. Stay in Florida, Pete. No, please come back. We miss you.
Thanks, guys.